Welcome back, traders. This is our weekly gold market update. Gold has moved lower in the past 2 consecutive weeks and has made a new low in the current, confirming the downward trend line that has been forming for months is still in play. However, with a rather exciting week ahead, including a number of fundamental matters and economic data, gold traders could be in for a treat. This report aims to briefly overview the current fundamentals driving gold's price, while our technical analysis will assist us with the latest price action. In the past week, important US financial releases may have set the tone for the yellow metals price to remain on the low. First of all, US consumer confidence for February rose from previous 89.3 to 91.3. Moreover, the initial jobless claims had dropped over 100,000 in the previous week, while the new home sales units and durable goods figures for January had also improved. The GDP second estimate for Q4 and the consumption adjusted figure for January both saw an increase. Even though these figures all point to economic improvement, they also provide some confidence that the economy could be heading in a more resourceful direction in later months. In the current week, gold traders could focus on the US employment report for February to be released on Friday the 5th. Some interest will also be placed on the 3rd of March when we get the ISM non-manufacturing figure for February, while on the 4th we get the weekly initial jobless claims figure. In our opinion, the US employment report stands out and should be given specific attention by gold traders, as the event can produce strong market moving results. During the past weekend, the Biden administration managed to secure a pass for its 1.9 trillion coronavirus relief package through the House of Representatives. The package will now be heading to the Senate for final voting and approval. However, due to the fact that the package is rather large and aims to support the economy on different fronts, the impact on gold's price action could be felt momentarily upon approval. Traders should be aware that gold's price may react accordingly if the package is passed through the Senate or not, due to the fact that the US government and the US Federal Reserve have taken immense action to support the economy since the pandemic broke out. The overall effect has been a cheaper US dollar, yet lately the USD has stabilized and has even shown some upward tendencies, which may have led to a drop even lower for gold's price. On a separate note, the US Treasury yields continue to be on the rise and have moved higher compared to where they were during our last week's gold report. Rising bond yields tend to put negative pressure on gold's price. Some analysts believe that gold's price activity is a current reflection of the bond yields rising, so traders are advised to be mindful of this information. As a closure, market participants have expressed worries over a potential rise of inflation in the next months in the US, due to the fact that economic activity seems to be improving, and at the same time, oil prices have risen steadily in the past months. Inflation is a matter that may need to be dealt with in the following months. Inflation tends to push gold prices higher, as bullion is used as a hedge instrument for rising prices. Moving now to our technical analysis. Please note this is gold's 4-hour chart. Now, gold continued its downward trend in the past weeks, closing February in red territory. Please note, since the start of the year, gold has dropped to an even steeper selling momentum, while the metal has dropped to a new low in the past days. Our first support level for this report is the S1 1700 round number. That has not been clearly tested since June 2020. If the selling persists and the price activity is moved even lower, then the S2 1670 hurdle can be the next stop. Our lowest level for this report is currently the S3 1645 hurdle that can be reached in case of a continuous selling momentum. On the contrary, and if the bulls are looking to gain back some of the ground lost, then the R1 1745 could come into play first. If the buying persists, the price action could move higher to the R2 1770 level that was tested many times in February, but mostly as a support. Our highest level is the R3 1800 line and could become a target in case of an extensive bullish trend. The RSI indicator below our chart has risen from below the 30 level, confirming the bears have dominated the scene in the most recent sessions. Now that's the end of this report. We hope you enjoyed it and found it useful. If you like this video, please make sure you share and subscribe. Thank you very much for your time and enjoy solid trading.